The same Wall Street banks that once called Bitcoin a fraud are now racing to sell it to you. Morgan Stanley, Goldman Sachs, Bank of America, they're all filing for crypto products. What changed? And more importantly, what does this institutional stampede mean for your portfolio? I'm going to break down exactly what's happening and what you need to know. This is Money Moves Daily, and today we're talking about the biggest shift in traditional finance's relationship with cryptocurrency that we've ever seen. Here's the number that tells the story. Crypto ETFs are projected to surpass $400 billion in assets under management this year. $400 billion. From major financial institutions. That's not retail traders on apps. That's pension funds, wealth managers, and institutional money pouring into digital assets through regulated products. The game has fundamentally changed. We'll cover the regulatory breakthrough that made this possible, which banks are leading the charge, and the practical moves you should consider, or avoid, as this unfolds. For years, major banks kept cryptocurrency at arm's length. They cited regulatory uncertainty and reputational risk. Some executives publicly dismissed Bitcoin as worthless or worse. The turning point came in 2025 with two landmark pieces of legislation. The Clarity Act established market structure rules, and the Genius Act created a federal framework for stablecoins. With clear rules finally on the books, the institutional floodgates opened. Banks that had been waiting on the sidelines suddenly had the regulatory cover they needed to move forward. This isn't just a few hedge funds dabbling anymore. We're talking about the largest financial institutions in America, actively building crypto offerings for their clients. The shift represents a maturation of the crypto market, but it also raises questions. Will decentralized assets maintain their original character as traditional finance takes over? Let's start with what's actually happening on the ground. The ETF market tells the clearest story of institutional adoption, and the numbers are staggering. According to 21 shares via the block, crypto ETFs are projected to surpass $400 billion in assets under management in 2026. That's a massive institutional bet. The speed of approvals has accelerated dramatically. The SEC's new generic listing standards shortened crypto ETF approval timelines from 240 days to as little as 75 days. That timeline compression is enormous. What used to take 8 months now takes 2.5. This means more products hitting the market faster than ever before. Bitwise projects that more than 100 new crypto ETFs could launch in the United States as these approval timelines compress. 100 new products in a single year. Morgan Stanley has filed to launch Bitcoin and Solana ETFs directly. Not through a third party, directly. One of Wall Street's most prestigious names is going all in on crypto. This is Morgan Stanley we're talking about, a firm managing over $6 trillion in client assets. Their entry signals that crypto has moved from fringe asset to mainstream allocation. And they're not stopping at Bitcoin. The Solana filing shows they're looking beyond the big two to offer exposure to emerging blockchain platforms with institutional-grade wrappers. Bank of America is making moves too. The bank is beginning to allow its wealth advisors to recommend crypto allocations to clients for the first time. Think about that for a moment. Your Bank of America financial advisor can now legally suggest you put some of your portfolio into digital assets. That was unthinkable 3 years ago. The advisory unlock is significant because it removes friction. Millions of Americans already have relationships with these banks. Now crypto is just another checkbox on the allocation form. Goldman Sachs conducted a survey that reveals the institutional mindset. 35% of institutions cite regulatory uncertainty as the biggest hurdle to crypto adoption. But here's the flip side. 32% see regulatory clarity as the top catalyst for adoption. That clarity has now arrived, and institutions are responding exactly as predicted. Industry analysts are describing this moment as an evolution. U.S. banks, which have only acted as custodians until now, are ready to become direct providers of crypto services. The stablecoin market is equally transformed. The Genius Act created a federal framework that separates compliant issuers from offshore alternatives, and that distinction matters. Visa has achieved more than $3.5 billion in annualized stablecoin transaction volume. That's payment giant infrastructure running on blockchain rails. The Genius Act was signed in July 2025, but full implementation rolls out in phases. Final implementing regulations are expected by July of this year. By January 2027, the act becomes fully effective. Stablecoin issuers will need to meet reserve requirements, undergo audits, and register with federal regulators. This creates a clear divide between compliant stablecoins like USDC and non-compliant alternatives. Regulatory status will increasingly matter for long-term viability of different tokens. There's ongoing debate about whether regulated stablecoins will marginalize offshore alternatives like Tether. The Genius Act essentially forces a choice between compliance and increasing scrutiny. Crypto purists argue that Wall Street adoption undermines the decentralized ethos of cryptocurrency. The whole point was to bypass traditional finance, not join it. Pragmatists see it differently. They view institutional involvement as validation and a path to mainstream acceptance. More money flowing in benefits existing holders, regardless of source. Both perspectives have merit. The truth is that institutional adoption will likely create a two-tier market: regulated products for mainstream investors and native crypto for purists. So what does this mean for you? Let's talk practical moves. First, understand that Wall Street adoption doesn't fundamentally change crypto's volatility or risk profile. If crypto wasn't appropriate for your portfolio before, institutional involvement doesn't change your personal risk tolerance. Don't chase FOMO just because Goldman Sachs is in the game. If your bank or brokerage begins offering crypto products, compare fees carefully. Institutional wrappers often carry higher costs than direct exchange access for the same underlying exposure. The convenience premium is real. You might pay 1 to 2% more annually for the privilege of holding crypto in your existing brokerage account versus a dedicated exchange. That said, ETFs offer advantages that justify higher fees for many investors. Tax reporting is simpler. There's no private key management, and they fit neatly into existing account structures. Consider crypto ETFs as a simpler alternative to direct ownership for tax-advantaged accounts. IRAs and 401k plans can't easily hold cryptocurrency directly, but they can hold ETFs. The 100-plus new ETFs expected this year will cover assets beyond Bitcoin and Ethereum. Solana ETFs are already filed. Others targeting different tokens are in the pipeline. More options doesn't mean you need to own more products. Diversification within crypto is different than diversification across asset classes. Don't confuse the two. The SEC's ambitious agenda for 2026 includes continued expansion of the crypto regulatory framework. The empowered CFTC will also play a larger role in overseeing crypto derivatives. The regulatory shift from adversarial to collaborative is notable. Instead of enforcement-first approaches, agencies are working with industry to establish clear, workable rules. This doesn't mean it's the Wild West. Compliance requirements are substantial. Banks offering crypto services must meet the same standards as their traditional products, or higher. Understand the difference between compliant stablecoins and non-compliant alternatives. USDC is designed to meet Genius Act requirements. Others may face increasing regulatory pressure. If you're using stablecoins for transactions or as a cash equivalent, regulatory status matters for long-term viability. The compliant options may become the only mainstream options. Let's zoom out and put this in historical context. Every major asset class has eventually been absorbed into traditional finance. Commodities, real estate, even art through fractional ownership. Cryptocurrency appears to be following the same pattern. What starts as an outsider challenge to the financial system eventually becomes another product on the shelf. Whether that's good or bad depends on your perspective. For mainstream adoption, it's clearly positive. For those who valued crypto's independent character, it's a compromise. For most everyday investors, institutional adoption means greater accessibility and legitimacy. The products are more familiar. The tax treatment is clearer. The custody is simpler. Watch the fee structures as competition heats up. With 100 new ETFs launching, issuers will compete on cost. Early products often charge more than mature ones. Historical data suggests that first-mover ETFs in new categories often see fee compression of 40 to 60% within 3 years. Patience can pay off if you're not in a rush. The 75-day approval timeline means you'll see new product launches throughout the year. There's no need to rush into the first offerings when more options are coming. One important caveat: past performance in crypto does not guarantee future results. Institutional involvement doesn't change the fundamental volatility of the underlying assets. Position sizes matter more than product selection. Most financial advisors suggest crypto allocations of 1 to 5% of portfolio for those with appropriate risk tolerance. Before adding any crypto exposure, consider your existing allocation, time horizon, and ability to stomach significant drawdowns. Institutional products don't eliminate the 60% crash risk. The smartest approach is to treat Wall Street's entry as information, not instruction. They're entering because they see demand from clients. That doesn't mean it's right for everyone. Use this moment to educate yourself, not to rush decisions. The products will still be there in 6 months, likely with lower fees and better competition. Remember that wealth advisors at banks are also salespeople. They have incentives to recommend products their institution offers. Independent research remains valuable. If your advisor recommends crypto exposure, ask about the fee structure, the underlying index methodology, and how it compares to competitors. Informed clients get better outcomes. The best time to establish your crypto thesis is before the sales pitch, not during it. Decide what role, if any, crypto plays in your financial plan on your own terms. Let's summarize where we are. 2026 marks a genuine turning point. Major banks are filing for crypto products. The regulatory framework is in place. Institutional money is flowing. Crypto ETFs could reach $400 billion in assets. More than 100 new products may launch. Morgan Stanley, Bank of America, and others are building direct offerings. The Genius Act has created clear rules for stablecoins, and SEC approval timelines have compressed from 8 months to under 3. The institutional infrastructure is being built. For everyday investors, this means more accessible options with familiar structures. It also means doing homework before products hit your brokerage account. Knowledge protects capital. The smart move isn't to act on headlines. It's to understand what's changing and decide deliberately how it fits, or doesn't fit, your personal financial picture. Quick reminder, this content is for educational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. That's all for today's episode. If you found this helpful, subscribe for more coverage of the financial moves that actually matter. Until next time, make your money move.